Hi, good afternoon, everyone. I hope everyone's had a delicious lunch and already feeling sleepy. But would like to just get everyone interested and uh, attentive for this wonderful session or discussion that we are expecting on this one. So, private credit and in the current times in India, well, it's a very exciting phase, I will say, currently, that we are living in, we are experiencing, and really fortunate to be part of this growing industry at this moment. The numbers itself tell a story if one were to look at it. It took private credit in India almost nearly a decade to scale up to a $10 billion kind of a AUM in aggregate. But if we see just the AUM deployment in last 1 year itself, in 2025, that itself exceeded $12 billion. So that itself tells a wonderful story that we have. While we are at 25 billion today in terms of total private credit in India, we are not stopping here. The projections clearly say that next 5 years itself, this number is going to double, or maybe much earlier than that. So it's a very, very telling time where this private credit has come back, or come out rather, from being just a funding gap filler, as many fund managers used to call it in the earlier days, to becoming a significant component of the overall investment portfolio for many, many fund managers or family offices or HNIs that we have today active in the country. In fact, we now have a very active, complete ecosystem in the country which is supporting private credit. We have starting from dedicated or specialized fund managers who are looking into only the credit space, to having investors who are only focusing on credit space coming to India, and also the credit focused investors taking shape within the country, and not to forget the entire army of the advisors and lawyers, where we have focus teams working on this space, and also the support teams from the trustees to the administrators and so on. In fact, having a separate private credit summit within IVCA, that itself should tell how this space has become important and significant in current times. So just taking forward, we have a very wonderful and hands-on panel of gentlemen today who have very closely seen this space evolve over the last decade, are very active in the current space, and are very, very excited about how the future unfolds in this space. So we would like to really deliberate that and understand how it has really come, as the topic says, from being just a niche area in the portfolio or in the overall investment gamut, to becoming a very core component today in the asset that the fund managers are holding today. So starting with Sandeep, how would you see, or would you say that how has this private credit come to become a core component from being a niche area, and not only from the investor standpoint, but even from the borrowers who are now quite open to consider this as a separate financing option?
Hi. So, thank you, Jigar. So, fixed income has, of course, always been a core part of portfolio of family offices as well as institutions. Now, I think the big change happened in July 2024 when the taxation regime on debt mutual funds was changed. So, before that, if you look at the math, see today performing credit funds offer a little bit lower yields, distressed funds offer a little bit higher yields. But if you take a broad average, post fees and expenses, a private credit fund would offer 15% to an investor, just taking an average. So post tax, it would come to around about 12%, right? Or 11, actually even 11%. So, earlier debt mutual funds were a wonderful alternative, because you could make 6.5% post-tax on debt mutual funds. So while of course there is still a 4.5-5% gap, The advantage of debt mutual funds was that A, they were without risk. There was very little credit risk. On private credit funds, obviously there is some credit risk. And second was liquidity. You know, a family office like ours values liquidity a lot. So for example, in COVID, because we had money in debt mutual funds, we were able to move it from debt mutual funds to equity mutual funds, which is what you cannot do in private closed-ended funds. But now what has happened is those same liquid funds are offering 4% post-tax, not even beating inflation. So obviously the entire math has tilted towards strongly considering private credit funds as part of the portfolio, because liquid funds are no longer viable. So that's really been, I think, the single most biggest driver of the growth in AUMs. Within that, I will say there are smaller family offices and larger family offices. Smaller family offices, I guess, would prefer to invest directly in funds because of diversification benefits and probably inability to really analyze the deal by itself standalone. Larger family offices, and I guess DSP would qualify to be a larger family office, often want to invest as a co-invest, where we are happy that the fund manager make fees, otherwise there's no alignment of interest. But a co-invest is much more preferred versus directly investing in funds, and that I believe is also the view of a lot of other larger family offices. You know, as far as borrowers go, it is an additional source of capital, so nothing much has changed. Earlier, they were borrowing that from some foreign funds. Now we have local funds also coming up as an additional source of capital, which is obviously welcome to borrowers.
Sure.
Yeah. So on the return perspective, as rightly mentioned by Sandeep, that liquid funds and money market funds, these are offering very low returns to any family office. So people, they really were looking for a solution which will give them good returns, but not the volatility of the equity markets. So that is where your two types of investment options come into picture. One is your private credit funds, another is your individual NCDs and individual bonds that are there in the market.
Yeah.
And there are lot of platforms now offering direct access to such NCDs, and which are yielding good, somewhere between 10 to 13%, 14%. So people who don't want to lock in into private credit, they can, and if they understand, to analyze a credit bond or a company very well, they opt for those individual NCDs, and they are of shorter tenure, like they are generally of 18 months or 12 months or 24 months. And if the family or the individual is comfortable locking it in it for 4 to 6 years, then your private credit funds come into place, which will offer anywhere between 16% to 17% post expenses pre-tax. And then your obviously taxation depends on the kind of entity you choose. So yes, now because there are so many options available, family offices are actually putting in a lot of wealth into private credit funds. In the last 2 years, equity markets have not given any great returns, single digit or no returns. And family offices were actually looking that, okay, something like a quarterly payout of interest will give them at least some return. And now what is happening is we are seeing some progress on secondary sale of units. So for example, if you buy a fund and after 2 years you want to exit, there are a lot of wealth managers who will help you to sell the secondary units of those private credit funds. So that is also helping lot of that gives some comfort to family offices. So that is on the investment perspective. On the borrowing aspect, I think AIF has provided debt to lot of SME, MSME and startup companies which didn't wanted to dilute equity, but they wanted a bridge, a small tenure loan for 12 months or 18 months, and they didn't want it to the promoters were not comfortable diluting the equity. So these kind of funds come as a saving grace to all these kind of companies. And obviously banks in India, they will not lend to startups. It's very difficult to lend against a land as a collateral. It's difficult to lend a property that belongs to an HUF. So there are so many no's for a bank and NBFC where these kind of AIFs come into picture. And lastly, acquisition financing. I think recently banks are allowed to come into acquisition financing, but before that it was not there, wherein these AIFs played a huge role. So I think that's the perspective.
Thanks, Sachin. So that's sure. Yeah, Nila.
Equity side, the long-term returns, if you see, if you're just a traditional passive investor, would be about 12-13%. So in a market like what we saw last 18 months, where people have made no returns or negative returns, so something like a private credit allocation would have at least made good, like, beating that 12-13, and average, I'm assuming 14-15% if you're at that rate. So at a portfolio level, it definitely works out to be a good hedge.
Right, right. So I mean, just if one were to sum up, it's really the customization that the private credit brings to the table in terms of the addressing the borrower needs, and also considering the securities that are on offer, and the and it has also been lucky, so to say, while also be getting active because of the external factors like the equity markets and the global situation turning in favor of a fixed return or a assured return kind of an instrument. And borrowers also being amenable to it has also made this space really break out from its shell, if one may say that. So while we are talking of borrowers, Abhimanyu, on the investor side, what kind of expectations are you would have, say, as an investor, in terms of, say, the portfolio yield, or particularly because in case of private credit you have to do a risk management regarding the downside, which could be significant if one were to see from a as a comparison to an equity instrument, where it may just go down but it may not become zero, whereas in case of credit you really run that risk. So how really are investors looking at it, and what expectations they have, and how do they change as we move forward?
Yeah, thank you. So I think so the first point, which I think so IVCA can play a big role in, that is actually to define what exact return is and what parameters they are. The point I'm trying to make is, I've seen some SOAs, and for the same type of asset class, somebody will take the value at face value, whereas somebody will discount future cash flows and then show, say, the RVPI of a fund. So a standardization approach, first of all, in the entire ecosystem is missing, and then you have to search actually what is the return. So that is, I think, so one major issue overall in the entire stack which is there. Now coming to return, like for example, our investment vehicles are non-corporate. Basically, you have trust, family trust. Now there obviously the tax rate being higher at 39%, obviously the return becomes lower relative to corporate. And the thought that we have, as he rightly mentioned, that when you had the COVID time, you could easily move money to equities. The problem today with the entire spectrum is that when you need money, you can't take it out. And then on the returns side, my calculation is that, say for example, let's talk about venture debt. Your absolute post-tax return for a non-corporate could be around 7-7.5% on the debt side. Now on the warrants, you have to wait for a period of 7-8 years before you get that incremental result, and with on a present value perspective, that could be an additional 4% kind of a return that you make. On the performing credit side, what is the return? Are we looking at the gross return? Are we looking after expense, after NPA, after carry? So first to fathom that what actually is the return, it itself is a challenge. Having said that, now a lot of the new instruments which are coming where sovereign has now got involved. Like for example, you have a lot of the infra related thing where you have a NHI there who's going to give you a significant, stable kind of a cash flow. I think so those assets are also quite attractive. That's a separate issue, that how much is the leakage and how much is the net return that you will get. Even solar is something that is there. And I clearly see a challenge happening both in terms of REITs because of liquidity, real estate office yield funds, and secondly from a retail investor perspective or otherwise, and because it's easier to sell, some of the money which was earlier in the credit funds now moving to SIFs because they are being positioned as a 8% kind of a product. So if you have a performing credit fund which will probably give you post-tax 9 to 10%, so it's easier to sell a 8% kind of a liquid fund. So those are some of the spectrum that one should look at when evaluating returns for all these under the overall credit space.
And Pradeep ji, if one were to ask you for what kind of must-haves that you consider for investors in this space, in the private credit space? Abhimanyu mentioned the returns are the key thing which are driving it, and the diversification that comes with that. But apart from the returns, do you also look at the overall investment manager's track record if you were to get, say, handed over the funds to a fund manager, or overall governance, transparency at the portfolio company level, or the quality of the security on offer? So what are the key must-haves that you typically consider when you allocate funds to private credit?
Hello. Can you hear me?
No, it's not on. Okay. It's on.
Yeah, look, if I am giving it to a fund manager, then it's not a discretionary fund, right? So apart from looking at the track record of the fund manager, if he doesn't have the track record, then maybe I'll have my own DD done on the fund manager by talking to him, because the portfolio that he will create, only he will create. I will not have a say in the same, unless until I am entering a existing portfolio. Otherwise I don't see my role to be played in anything else in there. Now, if I am doing, the previous panelist said that if it is an individual deal coming to me, then yes, the governance and the group and those things I will evaluate, because I have got the chance to do that. I can do that if a company is coming directly, I mean via channels, and if it is a good group and for some reason they have come for direct credit for some acquisition financing, which has now become RBI has allowed now, but there was some gap. So there were group which were coming. So there I can use these tools, understand the group, the transparency, governance, track record of the group and all those stuff. But so far as the fund manager is concerned, I doubt whether I have got a very big role to play.
Sure. And if it were to come to you directly, as you said, so what are these top parameters that you consider before going ahead with the deal, or which are like a must-have for that for that investment?
Well, look, I've got a term lending background, so it's a group. We have been taught to do a due diligence on the promoter than anything else. So the group will be the main thing.
Okay, that's interesting to know. So coming to you, Sachin, what sectors are you considering that are the top ones for investing in the space in terms of credit presently, and what new sectors that you think that could come up as we move ahead over the next 5 years?
Yeah. So when you look at the portfolio companies of many private credit funds, we see a lot of NBFCs in which they invest. So just to give you some names like Branch International or True Credit, these kind of, and a lot of other NBFCs, your Kirtana and other names. So NBFC is clearly one sector where a lot of AIF credit money goes. And for example, Vivriti and Northern Arc, these also lend to a lot of NBFCs. So NBFC clearly they borrow at maybe 12-13% from this performing credit fund. They can't borrow from venture debt because their borrowing is itself at 17-18. So unless they are lending at 24-25, then it makes sense, which very few do. But otherwise, their model is simple to borrow at 12-13 and lend at 18-20. And that's where they make the spread. So NBFC is the preferred sector. Second is, I see a lot of real estate credit funds coming up. In fact, our own company has also recently launched a real estate credit fund. So because real estate as a sector is attracting a lot of capital, and you see like ASK has a real estate fund, Motilal has a real estate fund, and so real estate is the second sector that I see, which is, there are specific funds only for real estate. So that's a big thing. So real estate, NBFCs, and third is your normal brick and mortar space, where you see industrials, that kind of. But yeah, these two, NBFCs and real estate, are the preferred ones.
Okay. And any new sectors that you think will open up, or you will want to consider as we move ahead over the next 5 years?
Yeah. So I'm seeing a lot of fintech and fintech, health tech, and ed tech coming together, and there are certain funds which lend only to these three sectors. And but though they come with their own set of risk, but they are coming up. I mean, only time will tell how good or bad the NPAs are, or the default rates are in these sectors, but they are coming up.
So that's actually like encroaching into the private equity space, really. But it's a very insightful thing to know that, where if one were to look at it from outside, and we know real estate has been the top sector availing the private credit in the last 5 years or so. But and so far, if you look at it from outside, it's like private credit competing with NBFCs. But here, what from we are hearing from you is NBFCs themselves are preferred borrowers, or they are considering this as a source of financing. So that's very interesting to know. And talking of that, Abhimanyu, what kind of different products do you see on this side for the private credit space, apart from typical NCDs that may be given by funds, or some pure loans may be extended? But I believe the spectrum is quite large in terms of venture debt or different kind of papers or specific units that can be considered. So happy to hear your thoughts on that.
Yeah, so as I earlier also mentioned about some of those products, but there are many other, you have securitized product like gold PTC, for example. Right. But in terms of, scaling that up, it's something which is very tough. You would need most of the, say, gold lending companies, to really have a strong distribution network to ultimately scale up those products like gold PTC. Now, coming to the other products that we already discussed, I think so what one needs to also look at, a lot of time as LPs, we just look at the return part, but we are not that much focused on whether it's a special situation, whether it's a stress asset, then what percentage of the return is coming from the equity portion and what percentage is coming from the debt portion. I think so those are something very critical that one needs to assess. And on the real estate side, I feel that with liquidity being better and you have hard assets, at the back end that you have, there's a tough competition to the overall credit space that will be there. Obviously, India is such a big, story, so private credit would also zoom well because of its, linear return relative to what happens in equities. But I feel that what one requires is significantly some improvement on the taxation side. That will really propel the entire industry and a lot of these products. And something can be done on the liquidity side. If those two things industry is able to do, I think so the sky is the limit for the entire industry.
That's interesting and point taken on that. But talking of the amendments and what needs to be done, there have been some very interesting developments, as Sachin and Pradeep ji already spoke of, was about this acquisition finance becoming enabled for banks, and which was hitherto not being done by banks and was one of the areas that was championed by private credit space. There also this very recently RBI has enabled the credit derivatives, again with the objective of further deepening the bond market in India and giving a further boost to the private credit space. So Nilang, any thoughts on that, or have you been able to go through those, because those have come just about 10 days ago?
Sure, I'll cover the acquisition financing bit. So what I've understood is the banks can fund up to 75% of the acquisition value. So this is largely done because there were a lot of these, for like let's say the top 20 nifty companies like your Adani groups, JSW groups, when they are going for a 10, 15, 20,000 crore acquisition, they cannot tap the private credit market for that kind of a check. So banks are always comfortable lending them because of their group vintage and balance sheets and all of that. So a large part of that money, I believe, the large part of that regulation has been brought in for these larger groups to help them with those larger acquisitions. However, people are perceiving this to be a competition for the private credit market. Like, now there is a competing term sheet from a bank also for that. So my views are like you can rather collaborate with banks, because if there is a large acquisition happening, let's say a 2,000 or 3,000 crore, the bank can solve for the OpCo bit. So here who benefits is the borrower, who will land up benefiting, because he need not pay like a 15% on the entire 3,000. He can probably get those 1,000, 1,500 crores from the bank, leveraged in the OpCo, at maybe 9% or maybe another 100 bips premium because it's a special situation. So he can probably get that tranche at a 9-10% from the bank, and the equity portion of it, that's where the private credit people can just pitch in and manage to bring in like whatever 15, 16, 17. So I feel it will be more of a collaborative approach going forward. Also, another differentiating factor for the private credit here can be like banks will not do pick structures like zero coupons, and usually this scale of financing does not have a regular coupon. So the coupon bearing structure can be done by the bank, and the zero coupon structures, the rare ended redemption premium related structures can be picked up by the private credit. So I believe this can be a very good collaborative approach going forward, helping the borrower also and also for the ecosystem. Like each one is taking a relevant risk.
Right. So it only further enhances the market rather than turning into a competition. And any thoughts on the credit derivatives that have come up, and are you aligned with the thought that it will help to deepen the bond market?
It definitely has to happen because internationally we are seeing it's there everywhere. So only in India now, if we are going to be a developed economy, these bond markets also have to mature. There has to be a lot more secondary trading of, let's say, illiquid credit also, distressed credit also. It has to really open up because that is somewhere I feel the private credit is lagging, because if a deal goes bad, there can be a buyer for that deal at maybe 50 cents. But that market is not so active. Somebody is willing to take that hit, somebody is willing to take that risk. But that market is not so prevalent. But if as the time passes, we get in regulations and ecosystem builds out, this should definitely happen going forward. Like, because internationally it is, like if something, there is a change in perception, it trades 60 cents to $1.
Right.
There's a buyer and there is a seller.
Right.
Yeah, this is the only bane of this is the major reason why credit is not picking up. It has not attained the depth. And depth can happen only if liquidity is there.
Right.
There is a buyer at any price. Only then, that is how equity has moved up. No?
Has moved up.
So that is the problem with credit. Whichever way, private credit or anything else.
Agree. So effectively, at least the panelists agree that the government is thinking right in bringing these things and attracting investors and offering alternatives for hedging their credit risk also by way of opening up the derivative market for credit as it was done for equity. So at least the steps in the right direction. So fair to say even the government and regulators are cognizant of the potential of the private credit space and want to support it to go forward. Talking of this variations or alternatives, different instruments that are there, Abhimanyu mentioned about securitization and PTC also becoming a theme. So Sachin, really your thoughts, if you have seen, or Pradeep ji, maybe if you can also chip in on how you see the securitization play happening, because while it has taken off, but it is again not having that depth as we would expect. So your thoughts on that, how do you see it?
Look, I have seen two interesting OCD deals. The borrower entity issues OCD, it gets classified as equity on its books. So that strengthens the balance sheet of the company. And that conversion clause, and that is picked up by, in one case, although it is a convertible instrument, it gets classified as equity. If it is an NBFC, maybe it is a tier 1, tier 2 capital. And then conversion wise, they give you 14, 15, 16% kind of an IRR. So this is one thing which I have done. Another thing is that there is a borrower which has issued the OCD. It goes and sits on the balance sheet of the borrower entity. The recourse is on the other balance sheets of the same group. So after 18 months or 36 months, whatever be the tenure, those OCDs will be bought over by the other group companies. The entity, the borrower entity's balance sheet gets strengthened. It was also an acquisition financing.
Sure.
So OCD I have seen, convertible CCPS I have also seen. So those two things, different instruments I have seen.
So that would be more on the hybrid side or a convertible debt kind of instrument. Mainly, I was referring to something like PTCs or a securitization play where, the originator gets a cash out from the new investors, and with the new funds, the originator can further churn and increase the further credit transactions that it may be doing on and off basis. So, Nilang, any thoughts, your thoughts on this?
So I have seen a few PTC transactions. So definitely it makes a lot of sense in terms of structure, like you are the person the originator is getting an exit and he can recycle the capital, and there are structures where there is a cash dastra, you're taking a higher cover of the pool, and it's a very diversified pool of borrowers, like can be like 3, 4, 5, 10,000 borrowers, and these will be retail loans, gold loans, home loans, all sorts. So from a optics, it looks like a good trade to have. I've not really seen a lot of AIFs do these PTC trades. So optics, I was convinced, but there has just been one structural issue that I've always found is not yet solved for. The borrower, the originator, lands up being the servicer for these loans. So what happens is, at the end of the day, he is collecting all these loans because it's the master escrow and there will be an ECS notch on the borrower. So the money gets collected in his master escrow, he'll reconcile, who's paid, not paid, and then he will transfer to the PTC holders eventually. So what I always found it challenging is he's yet controlling that cash flow. If things were to go south for this borrower, in this market anything can happen, because he has smaller NBFCs, let's say 3,000 crore AUMs. So if something was to go wrong, he would control that cash flow. He can very well divert that cash flow to his other needs and other lenders who are more pressing. So that just defeats the whole purpose of the PTC structure, I feel. So somewhere I have given this feedback to people who have come up with these structures, that if you can come up with a tech solution where the money that is collected from the borrower automatically gets redirected to the PTC holder. I have not come across that yet. But if that happens, then I think so there is a play. There is definitely a play. But I have seen across 4 or 5 different originators who regularly do these PTC trades. It continues to be this fashion. Everybody says that we can change the servicer, but that does not really work in the real world. When you have like 10,000 borrower, you cannot send a third party to go and collect your EMI, and it's not relevant. Why will that person pay you also? Why will he trust you? So that structural issue, it's been so many years, but I feel that's yet not solved for.
No, that's right. Yeah, Sandeep.
That solution is now there actually. Recently NCPI has come up with that, wherein at the time of disbursing the loan, you have to fill a particular field which will then allow you to change the account into which the ECS mandate will flow into. So if that is done ab initio by the originator, later on you can ensure that the retail borrower's money is directly going into the trustee's account.
That's very useful to know, Sandeep, because this being on this side, on the consulting side, and a lot of our clients have been having very similar concerns, as Nilang was mentioning. In fact, we also saw some very briefly, but some traction on foreign players coming and setting up dedicated collection agency kind of a shop here. But as you rightly said, if the portfolio size is huge, and generally it is huge, exceeding thousands also, it is very difficult. They are finding it difficult to scale up, have that network on the ground, and do the collections, because at best they are setting up say call centers and few connecting with some local vendors, but to have that complete geographical reach is becoming a concern. And also being in this space for more than 10 years on the consulting side, on the credit side, I can tell you why AIFs have not been doing it, because of the tax reasons. So there are some different views available, and there are different views being adopted, and where the taxation can go as high as 40%. So it's really directly, either in terms of non-residents, the FPI is directly investing, or if you have a private NBFC which is going to invest, or a mutual fund, they pick up this PTC. So that's the thing that we are seeing here. Moving on to the next question, and really for Sachin, we have seen various geopolitical tensions happening in the last couple of years. It keeps coming back again based on just yesterday's news that we saw. But the private credit in India has kept moving on and growing. So what do you think has been your experience in the past couple of years when these kind of stresses came into the system?
Yeah, so in fact, because of all this geopolitical tension and tariff wars, it has only improved the market in a way. It has been positive for the credit market because equity was beaten down badly, and people were really looking that, okay, where should we invest now, because no one knows when the wars would end, no one knows when this tariff tantrum would end. So people were looking for solutions, and we saw like good amount of AIF credit 2 funds being launched, and they were like fully subscribed. Like in a matter of time, everyone was able to raise funds, and they all, each family office, every investors was looking for a regular cash flow kind of solution where the principal is safe and you get your quarterly payouts. And as we all discussed, your returns are 16% kind of returns pre-tax. So though post-tax would be maybe 10, 11 depending on what kind of structure you choose, but it is still positive number. 10, 12% is more than your equity returns that was there. So in a way, it helped the market raise more funds, and even for borrowers, because valuations dipped, they were not able to raise equity funding at the desired valuation, because when the markets fall, people ask for valuation discounts, which promoters are not willing to give. So even they were looking that, okay, now that we want to borrow, rather than diluting equity, let's go for credit and raise money through credit funds, because though it might be expensive, but at least it will not dilute your equity. So yeah, in a way it has been positive for the credit market. At least it has picked up very well in the last 2 years.
Because actually borrowers have faced the brunt of the tariffs really, and also the supply chain disruptions because of the wars going on. But despite that, they have focused, or they have considered private credit as a credible alternative. Is something good to know and likely to go ahead. Then basically then the space is in a way fortified in that sense, even if we see the disruptions going ahead. And Sandeep, on similar lines, we've seen FPIs also pulling back money more from the equity markets. But on the credit side, we continue to see traction from the foreign players coming in. And even do you see that kind of a trend continuing? And also on the credit side, the Indian investment market following the equity trend, where you have the domestic institutions standing up even if FPIs or foreign players are going to have a pullback. So whether foreign players in credit side are likely to get a pullback, and even if they do you see the domestic credit players stepping in?
See, I will say that foreign funds first look at the yields in their home market, which for most of them is the US, because right now yields in the US are elevated. Their attraction towards the Indian debt markets is actually lesser than in the past, because if on a bond with moderate risk they can make 9% dollars in the US, why would they come to India for an 11-12% dollar risk after hedging costs and withholding tax? It's not worth the brain damage. So right now I will say, because of the increased interest rates in the US, India as well as other emerging economies are less attractive than in the past to foreigners, simply on a relative basis. For Indians who are domestic investors, they can't invest in foreign markets beyond the LRS limit, which is quite modest. This obviously continues to be an excellent diversification option, and continues to be that so. As far as pulling out money from the markets in the event of some macroeconomic crisis, the equity markets are much more liquid and deeper, so you can do that easily. You cannot really do it from the debt markets. So the good thing about the debt markets is whatever the money is inside will continue inside, because it's not so easy to take out money. Plus in India, funds are closed-ended, at least those governed by SEBI, right? So in the US, for example, we have a kind of a mini crisis. I would not call it a crisis, because the SEC allows 5% fund withdrawal every quarter. Now the parallel of that is not allowed in India, which means that any crisis will be led by only credit reasons, not ALM reasons. So I think there's a good justification for the regulator to do so. So yes, it will not be as volatile as equity markets because of the regulatory thing, that you can't withdraw money in between, as well as the very fact that the markets are not that liquid.
But talking of that, actually, if you see currently globally the credit space or the credit investors, they are facing a lot of challenges because of the a large amount of credit extended to the tech companies or the BLDCs as they call in that space, and they finding it very difficult with the advent of AI and the returns coming or the timelines being met in terms of that. So and we don't have that kind of foray into the tech space in India today. So in a way, even from that perspective, India seems to be fortified and protected, and at least the private credit play, the way it has gone or played out right now in the market, is likely to continue then. But one or a couple of closing questions as we move towards the end of it, and this is a common question for all the panelists. So if one were to see this private credit unfolding over the next 5 to 10 years, and if you look at a well-constructed credit portfolio for a sophisticated investors like all of you, how do you think that would look like? What components, what kind of diversification or allocation you are likely to give? And while we spoke, we touched upon this, but one or two policy changes or change in terms of borrower attitude that you require that could further expand the private credit space as we move ahead. We can go in any order with this panel.
Yeah, so I'll start maybe. So I clearly see that family offices will allocate more and more to private credit funds going forward, because we have seen a good traction till now, like the number of funds that are floated in the market. There might be some, dip in returns, but we have not seen some major defaults by the AIFs on giving the quarterly coupons that they have promised. So there have been cases like, for example, Blue Smart. There were a couple of AIFs which had lent to that company and the returns dipped. But overall, it has been a decent experience for most of the investors of AIF Credit 2 funds. So I clearly see, and we see a trend of these funds offering co-investments where people are showing more and more interest. So that is also, attracting interest from investors. And secondly, I think one change that you asked, that, as and when the secondaries market of these credit funds deepens, or, if there are more players who are buying the secondary units of these credit funds, it will attract more and more to family offices, because that will give some liquidity in case they want to exit in between. So that's my say on this.
Yeah, liquidity is the key. The recent steps, the derivatives and all those stuff, if they start, we'll have to see how they pan out actually. That will help a lot in developing this credit market a lot.
Right, because even today we do have the listed bond mechanism, but we don't have enough players trading in it. So any thoughts around that? Or of course, Nilag, you can take a shot on the question.
So one is the exit velocity of your earlier fund. Like now, I believe a lot of them have had their first fund, or some of them are again very matured. But if you're able to quickly demonstrate an exit, so it's assumed that the similar investors will come back to your second, third funds with much larger checks, because you have already proven, you committed something and you've given that kind of a return and that exit, and you have proven that whatever I have invested into is sellable at the end of the day. That is why you got the exit. Secondly, one regulatory change you mentioned, I think so SURFACE, if the AIFs can directly access that, so then there is a faster resolution. Otherwise, it's a very long process of NCLT. It takes years and it will eat into the return, liquidity, spoil the whole game, like at the fund level, at the investor level, like, because if you are running a fund of, let's say, 12, 15, 20 ideas, just by probability, it is possible one or two deals would just see a gap in your expectation. So that's where you need a faster resolution mechanism. So in terms of regulation, that needs to catch up for AIFs, I particularly feel. Thirdly, very importantly, I feel at a fund level, leverage in India is yet not allowed. We have done something internationally on that. So disciplined leverage, not that you are already, so what happens internationally is you'll end up doing very high rated credit with leverage to get those high yields. So, if you are investing to a very, very good rated corporate or a bank's bond of let's say 7% now, and then you lever it, in a disciplined manner, you can reach those 11-12% dollar returns, which are great returns. In India, just to meet those high yields, people start taking disproportionate risk. So I feel Indian market can also evolve where, I can leverage a AAA rated portfolio and improve my IRRs. I feel that leg is missing. For that extra 3-4%, I'm more comfortable leveraging rather than taking disproportionate risk to get that higher yields.
No, that's a fair point. And for AIFs, I think at least the listed NCDs give them that SARFAESI protection. But then you need to go through the listing process, the whole EBP bidding, etc. That has to happen. And also there are some implications, accounting and tax also for the borrowers issuing the listed NCDs. So that is restrictive, I agree. And some more flexibility or coverage under the SARFAESI would certainly help. So that's definitely there. Abhimanyu, your thoughts on?
So, continuing what Nilang said, I think so leverage is something which is very important. And I think so at the SPV level, there is clearly a leverage game which could be there. As I was discussing about the sovereign backed, say something on the road side, solar side, there we've seen funds on the SPV level, leverage. And that is really kicking in a lot of returns, at least at the gross level for investors. I think so that particular instrument going forward should do really well, clearly on this parameter of excessive return, at the same time stability of cash flow. See, what anyone today is, when investing in debt, he's worried is whether my money will come back. Now, if there is a sovereign cash flows which will come, and then there is a leverage, and because of that your return on equity improves because of the spread between that and the debt. I think that is something very critical. Just one point I wanted to say, some disagreement to what Sachin said. I feel that when the market, like today we had this kind of a crisis, say 3 months back, I would say people will focus more on getting into equities, because from a very traditional mindset, I'm looking at dividend, earnings yield versus 10-year. So in that kind of a market, actually it becomes make more sense to go to an equity rather than on debt. On good times, yes, it makes sense to be on debt. So that would be a little bit of a difference I would have. Thank you.
Sure. No, that's useful. And on the leverage side, yes, so that's the next leg of development or maturity that the credit side, credit funds can have, and to offer a more balanced or take a more competitive bet, if I may say, on the borrower companies. Sandeep, your thoughts on the questions?
I'll say the most important thing for the industry to have a strong secular growth is no major blowouts or accidents, because family offices have not really seen, and hopefully they don't see also, any major blowouts or accidents. So because how they will react to that is an unknown. And if you take a parallel of this with the NBFC industry, see, pre-2018 NBFCs were the biggest providers of alternate capital. Now of course it's credit funds. So in the NBFC world, if one NBFC were to go bust, it would suddenly impact the liability profile of all the other NBFCs. So here the risk is that one or two funds in a very large industry don't do so well, and then it can impact the entire industry. So that is the risk. But otherwise, there's a diversification benefit, and there is definitely a space for private credit in the portfolio, and there should be a secular growth.
Sure. Thank you. Thanks for your really insightful thoughts and discussions during this panel. And if we have 5-10 minutes, we can take questions from the audience for any of the panel members.
So we can take 1 or 2 questions. We
Sure.
have 2 to 3 minutes more. Yes, can we quickly pass the mic here? Yeah, this side.
Yeah, sure. Thank you.
Are you becoming less of an LP and more of a direct investor / lender? Or, family offices. My direct question to you is, maybe I would like Pradeep sir to answer that family offices, from being traditional LPs to other funds or other participants in the private credit fraternity, Are you going to the direct investment way that no, I don't want a third party to do diligence for my investment, I'll do it directly, and you are developing team of its own, or overall the family office is moving in that direction?
Hello. Hello.
Yeah, please.
No, that's a wish list, but the problem is that family offices are very thinly manned that way. They are not very big team which are working there on that. But yes, this is the ideal situation to be in. Direct investment that is why all of us mention about doing a co-investment. That is also in a way direct investing only. So everyone is looking for co-investment, but then there is an entry barrier. You have to put in a check of 4 crore, 5 crore, 10 crore to be able to do co-investment. But yes, we do look at direct deals. And as I said in the previously also, that group then matters a lot. Otherwise what private credit are doing, they are only financing the non-finance sectors like real estate or acquisition financing, startups and all those places. Normally private credit play is happening in that area only. So direct deals, if they come, they are most welcome.
Yeah, and also like direct deals do come to us, but we actually prefer going through co-investment because then all the, as he rightly said, it's a thinly manned. All the family offices have 3 to 4 people mostly, unless you are a Premji Premji Invest or a Catamaran which will have a large team. It's thinly manned. You really don't have the capacity to do the due diligence of collateral and all the covenants. And when there is a covenant breach, what do? I mean, you really can't go and talk to the company. But if you do through an AIF, the AIF will represent you and ensure that whatever steps are to be taken for that covenant breach. And especially in case of default, what do? You simply can't go to the company, but the AIF will represent you and at least try to get whatever possible money you can get back. So definitely direct. So in co-investment, what they do is they as you rightly said, put a 10 crore check, get co-investment rights of 10-20 crores, and then amongst the pool of 20-30 companies, you choose whichever you like. But your rights will be equal to the fund rights. It will not be lesser or higher.
See, with size, a lot of people end up getting professional management within the family office. So it all depends on the manager at the family office level. How comfortable is he underwriting deals, what background experience he is coming from. That does not mean that the LP allocation goes zero, because that's where you get the learnings also from. Like, no family office is designed to run like a fund across asset classes. So there would be some passive LP allocations where you get the learnings, and then where you get those co-investment rights and deal flow. And a lot happens amongst the peer circles also of family office networks. Like, if somebody is doing the deal, has done a lot more deep dive, you go by his conviction of diligence. You understand the deal, but then not everybody individually will diligence the company. So then each one has a peer network like of 15-20 family offices where they would discuss, and that's where you can take those co-investment or calls. But I've not really come across anybody going direct. Like, there are 1 or 2 of them, just hardly, directly with the full deal themselves.
Thank you.
Thank you so much.